Welcome to the Deep Dive, the show that gives you the ultimate shortcut to being well-informed. Today, we are strapping in and diving deep into the holdings of Monesh Pabrai.
He's often called the ultimate cloner of Warren Buffett's philosophy.
Exactly. And we're dissecting his Q3 2025 13F filing for Dalal Street LLC to figure out the specific high-conviction bets he's making right now.
And to really get this portfolio, you first have to understand his core principle, Dhandho.
Dhandho.
It's a Gujarati concept. And the investing maxim is, well, it's pretty simple. Heads, I win big. Tails, I don't lose much.
So the whole mission is finding these low-risk businesses that are stuck in these high-uncertainty environments.
Right, industries that the broader market just sees as, deeply distressed.
And based on this filing, which is about $336 million, distressed is exactly where he went hunting. I mean, this is the definition of hyperconcentration.
Oh, absolutely.
We're talking just 5 stocks, 5 U.S. holdings making up 100% of the capital, and they're all clustered in just 2 cyclical, highly unloved sectors.
Metallurgical coal and offshore oil and gas drilling.
Okay, let's unpack this. If he's betting this heavily, he must have found a nearly bulletproof margin of safety. What's the specific arbitrage he's targeting in these 2 unloved sectors?
Well, it all comes down to exploiting what we call the mispricing gap.
Mispricing gap.
Yeah. The market often confuses high uncertainty like, volatile commodity prices or day rates with high risk, which is the actual likelihood of permanently losing your capital.
And that's the key distinction, right?
It's everything. Uncertainty is scary. It's visible. Risk is often hidden on the balance sheet. So when the market sees all that uncertainty, it just prices the assets as though they're incredibly risky.
Creating a huge opportunity.
For a patient investor, yes. The safety net is twofold. In offshore drilling, the safety is all asset-based.
Meaning the rigs themselves.
The rigs and the drill ships. They're being acquired at a massive discount to their replacement value. I mean, it costs over $1 billion and takes years to build a new high-spec drill ship. You're buying an irreplaceable asset for pennies on the dollar.
And for the coal miners, what's the floor there?
For them, the margin of safety is based on the net present value, the NPV, of their proven reserves and their future cash flows. He's buying assets cheaper than their intrinsic worth. It's that simple.
So let's look at the actual moves in Q3, because this was not a passive quarter.
No, it was a very focused reallocation of capital. See, when you're fully invested like he was, you have to sell a good investment to buy a great one.
And the source of funds for that was?
The complete liquidation of AutoNation, the ticker AN. He sold 100% of his shares.
Which is interesting because AutoNation was doing well. They even reported strong results that quarter, so why sell it off entirely?
It's a classic Pabrai move. It's about maximizing the potential return of the entire portfolio. AutoNation was a good, safe holding. It was profitable. It was liquid, which made it the ideal candidate to harvest when a fatter pitch came along.
A fatter pitch in a more distressed sector.
Exactly. It wasn't about AutoNation underperforming. It was about a much better asymmetric opportunity presenting itself.
Which brings us to the new buy. He took that capital and deployed it into a massive new position in Transocean, ticker RG. It immediately became 22.6% of the portfolio.
And this wasn't just a new buy. You have to see it as a strategic swap within the drilling sector itself.
Okay, explain that.
His total exposure to offshore drilling stayed pretty stable. It only went from about 46% down to 40%. He didn't exit the sector. He just refined the risk profile dramatically.
So he funded the Transocean purchase by trimming his other drillers.
Precisely. He trimmed the 2 safer ones he already owned. Valaris, or VLL, was cut by over 40%, and Noblecore, NE, was cut by a huge 86%.
So he's selling the companies with stronger balance sheets to buy the most highly leveraged, distressed player he could find.
That's the read. He's going for higher torque.
Meaning he thinks the stock will react more violently to the upside if the recovery continues.
That's it. He believes the upcycle is now de-risked enough to move away from the safer plays and into the name that gives him the most bang for his buck if he's right about 2026 and 2027.
Here's where it gets really interesting. Let's look at these industry theses, starting with met coal. It's almost 60% of the portfolio. Why this massive bet on what everyone else thinks is a dying industry?
Because met coal is fundamentally different from thermal coal, the stuff used for electricity. The whole thesis is built on a really compelling supply-demand imbalance.
Okay.
First, supply is just structurally constrained. Decades of underinvestment, intense ESG pressure. I mean, practically no new major met coal mines are being developed anywhere in the world.
But the demand is still there.
The demand is stable and actually growing. driven by industrialization in places like India. And crucially, you cannot make primary steel in a blast furnace without high-quality coking coal. It's irreplaceable for now.
So the play is simple. Buy the lowest cost producers when the cycle is weak. Let's start with Warrior Met Coal, HCC. It's 34% of the portfolio.
Right, and their moat is being a pure-play, low-cost producer of premium coal in Alabama. But the real thesis, the actual arbitrage he's betting on, is one single project, Blue Creek.
The Blue Creek project.
Yep. Most investors look at HCC today and they see declining income, negative free cash flow for a bit, and huge capex. To them, it looks like a value trap.
But the Dhandho math tells a totally different story.
A profoundly different story. Management says the project is on track for first production no later than Q2 2026. This isn't a guess. And they project its net present value, using conservative coal prices, mind you, will be a staggering $5.4 billion?
Wait, let me stop you there. $5.4 billion. The company's entire market cap is around, what, $4.2 billion?
Exactly. So the proven future value of this one project is $1.2 billion more than the cost of buying the entire company today.
He is literally buying the Blue Creek project for less than it's worth.
And getting the entire existing profitable mining operation for free.
Wow.
It is the textbook definition of asset arbitrage.
That is compelling. Okay, what about the other coal holding, Alpha Metallurgical Resources, AMR? He actually added to this one.
He did, by about 15.6%. AMR is the king of scale. It's the biggest U.S. supplier, have logistical advantages, but the specific angle here is what you might call the cannibal thesis.
As in eating their own stock.
Exactly.
Yeah.
Management is aggressively buying back their own shares. They've already spent $1.1 billion of $1.5 billion authorization. The share count is shrinking fast.
So by adding to his position, he's just amplifying that effect for himself. His ownership percentage of the company grows without him doing anything.
Precisely. And the margin of safety here is that AMR has a fortress balance sheet. It's a net cash position. This isn't a distressed company. It's a very well-run company acting intelligently within a distressed sector.
Let's pivot now to the other big bet. Offshore drilling. 40% of the fund. This industry was just destroyed after 2014. Why bet big on a recovery now?
Well, that cyclical pain is exactly what created the opportunity. Supply is just. It's profoundly constrained. All those rig retirements in the last decade mean the existing fleet is basically irreplaceable.
Right, we talked about the cost of building new ones.
$1 billion plus, it's just not economical. Meanwhile, demand is recovering strongly, driven by energy security concerns.
And the result of that is?
Soaring day rates. We're seeing rates for high-spec floaters hitting $500, even up to $635,000 a day.
Okay, so that sets up the Transocean, or rig, the massive new buy. But it has over $4 billion in net debt. That sounds like the definition of high risk.
It sounds like it. That's the high uncertainty part. But the risk, the chance of it going to zero, is mitigated by one phenomenal number: the contract backlog.
The backlog?
Transocean's current backlog, its contracted, visible future revenue, is a staggering $6.7 billion.
Let's run that comparison again. The backlog is $6.7 billion, and the market cap when he was buying was?
Just about $4.4 billion. He bought a company whose locked-in revenue stream is 150% of its purchase price.
So that $6.7 billion is the cash flow bridge.
It's the bridge. It services the debt, and it gets the company across to that 2026-2027 inflection point when these new super high day rates really start to kick in. The backlog guarantees survival, and the leverage guarantees maximum upside.
And what about Valaris and Noble, the ones he trimmed heavily? Were they just bad investments?
Not at all. They were fantastic investments that served their purpose. Valaris is known for operational excellence, has a much stronger balance sheet, its value is clear.
And Noble, the 86% trim.
Noble has that consolidator's moat, built through M&A. They have a massive $7 billion backlog. The heavy trim just signals that, the thesis played out. The job was done, the gains were banked, and the capital was freed for the next higher torque opportunity, which was rig.
So when you put it all together, what does this all mean? He's really executing two very specific types of arbitrage here.
That's right. In Met Coal with Warrior Met, it's a clean asset arbitrage. He's buying a specific project, Blue Creek, for a price that's way below its proven net present value.
And the offshore drilling play.
That's a backlog arbitrage. He's buying companies for market caps that are less than their fully contracted visible revenue. He's basically found low-risk bonds, the backlogs attached to these high-upside equity options, which are the irreplaceable rigs. It's your Dhandho.
You know, the most subtle move in all of this, maybe the most difficult one, was selling AutoNation to fund the Transocean bet. It forces you to ask a pretty tough question. How often do we, as investors, need to harvest a good, safe investment to fund a truly great, high-conviction opportunity? What profitable, safe investment are you holding onto that might be better deployed somewhere else? It's a compelling thought to mull over.
It really is. And on that note, we have to remind you, please conduct your own due diligence before making any investment decisions. All the analysis here is based on publicly available sources and is purely for educational purposes. This is not investment advice.
Thank you for joining us for this deep dive into Monesh Pabrai's hyper-concentrated Dhandho strategy.